Alright, now we move on to page 79 of our textbook. Alright, so here we have the format of the financial statement. Alright, so format of financial statement we have two, which is number one, statement of profit or loss. Okay, and then this is for example for the year ended, and then this is for the date. Alright, for example, statement of profit or loss for the year ended 31st December 2018. And then on the page 80, we have the statement of statement of financial position is at 31st December 2018. Alright, I'm going to explain you one by one of the statement of profit and loss first. Right, so the first thing we have to find the sales. Alright, sales we have to less with the written inward. So in order to get the net sales, so sales we have to minus with the written inward or sales return. Why sales return? So it means that if we make a sales and then the customer return back to us, so the amount of sales is going to be reduced. And also we have to minus with the discount allowed. Discount allowed is the discount that we give to our customer. So after we get the sales minus with written inward and discount allowed, or sales discount, the other name, so we are going to get our net sales. Okay, so this is our net sales. So after we get our net sales, we are going to get the cost of goods sold. As I mentioned earlier, so opening inventory, add with purchases, and then we minus with return outward or purchase return, and then we minus with discount received. So it means that here purchase means that when we purchase, we have to less with the return outward. Why? When we return our goods to our supplier, so our purchase will be different. And also if we are being given the discount by our supplier, so the cost of purchase also will be less. Okay, so after the opening inventory plus purchases, less with the return outward and discount received, we are going to get our net purchase. So this is our net purchase. And then we are going to add with other expenses here. Expenses on purchases such as carriage inward, duty on purchases, or insurance on purchases. So this three things is actually, it will increase the value of our purchases. So we add up these expenses on purchases, we put it over here. So our opening inventory here, okay, so we add with our expenses on purchases, so we get here alright, cost of available for sale. Okay, so this is our cost of good purchase. Just now is cost of our cost of good purchase. So when our opening inventory plus with our cost of good purchase is going to give us cost of goods available for sale, and then we minus with our closing inventories. So after we minus closing inventories, then we get our cost of goods sold. Okay, from here move to here. So if we already get our cost of goods sold, so we take our net sales and then we minus with cost of goods sold, we are going to get the gross profit or gross loss. If positive, gross profit. If negative, gross loss. Okay, so after we get this one, we have to add with other revenues. For example, here rent received, commission received, and interest received if we have, right? So we add up here, we put over here. Okay, we put here. And then we less with expenses. It doesn't matter what kind of expenses, we just put over here. Salary and wages, insurance, rent expenses, interest expenses, carriage outward. So carriage outward will be here. This is a normal expenses. But if we have the carriage inward will be here. Okay, so do not mix, right? I would like you to highlight again. So the carriage outward will be in the expenses. The carriage inward will be expenses on purchases. So we add all the expenses here, we put it over here. So our gross profit, we add with revenues, and then we minus with expenses, and then we get figure here. So if profit, we call it as a net profit, is negative, we call it as a net loss. So the net profit or net loss, we are going to bring to our statement of financial position. So statement of financial position, as I mentioned earlier, so under asset, we have non-current asset, we have intangible asset, and we have the current asset. So here, so all the non-current asset, land and building, motor vehicle, office equipment, machinery, fixtures, and fitting. So this is the cost, right? Okay, it's going to give you inside your trial balance. And then this is the accumulated depreciation. So accumulated depreciation, it means that the depreciation every year, but it add up from the beginning. So that one is, we call it as the accumulated depreciation. So how to get the carrying value? The cost minus the accumulated depreciation is going to be equal to the carrying value. So all those things is the same. The cost minus accumulated depreciation. So we are going to get the carrying value. So intangible asset means that the asset that we couldn't touch, we couldn't see. So the one is intangible assets, such as goodwill, patent, trademark, and franchise. So this one we add up over here. This one for the non-current asset, we add up, we total over here. And the intangible asset, we add up, we put over here. So okay, this one is also we add up with the investment. So total this one, we put over here. Okay, so current asset, the closing inventory, account receivable, cash at bank, cash in hand, prepaid expenses, and accrued revenues. So this is for the adjustment later on. Prepaid and accrued, we just add up all the current asset, we put over here. So we have to plus our non-current asset, our intangible asset, plus with the current asset. So total is going to be here. Okay, and then the other side is our owner's equity, alright, and then the non-current liability and also the current liabilities. So owner's equity, capital at the beginning of the year, plus with the profit. So the profit here comes from our previous here, so bring it to here. Alright, so this is our net profit or net loss. Is profits, we add, loss, we minus. And then we less with our drawing. So this one we are going to get capital at the end or ending capital. So beginning capital plus with profit or minus with loss. So and then we minus with drawing. So this is the capital at the end. Okay. So next one, we have to calculate for our non-current liability. For example, long-term loans, mortgage on premises. We add up, we put over here. And then our current liability, bank overdraft, account payable, accrued expenses, and prepaid revenues. So we put over here, we add up, and then we total up from owner's equity, non-current liabilities, and our current revenue. So this figure right here. So this figure, our total asset is going to be equal with this one. Okay, equal. If we do not get it equal, so it means that there must be something wrong with our statement of profit or loss and statement of financial position. Right, if you refer to your book, page 81, alright, preparation of the pre-adjusted financial statement, you may have to try that one, and then you can check your answers at the back on page 82 and 83. Thank you.